A very good morning to all of you students. Today we are going to do the live revisionary virtual classes on the topic of the balance part of the derivatives and the new topic of interest rate risk management. So students, in our previous session, we have covered the topic of derivatives up to options. And in that, we have also discussed the concept of options, wherein the call option and put option was discussed. But just to start, let me just let us just have a quick recap. So option students, we discussed that there are two different types of options. One, there is a call option, and second, there is a put option. So for call option, we said that it's a right, it's a privilege to buy an underlying asset at a specified price, at an agreed date, or up to an agreed date. Okay, that is where the European option and American option came into the play. So here we said that emphasis is on to buy. Okay, the emphasis is on to buy. Similarly, the put option is the option to sell. That means in case you are having a situation to sell any underlying, then you can enter into a put option depending on what is the pricing, what is the timing of that option exercise, and all those things, right? Then we discussed about that the parties to the options are different from the parties who are actually dealing in the underlying, right? This is true for all the derivative students. So this is what all things we discussed in the previous session. Even through this example, we discussed that what are the different payoffs going to be. Now in today's session, let's start with the concept of the different payoffs diagrams. Okay, the different payoff charts. So in this case, we are assuming the strike price to be 40 rupees and the premium of 5 rupees. Okay. Call option, who is the buyer, holder. This is from the perspective of the call option holder or a call option buyer, whom we call is having a long position in call option. Okay. So in this case, if the price is up to the strike price, if you see up to 40, there was a good amount of loss. The loss was constant to the 5 rupees of premium. The moment price kept on increasing, the payoffs will also increase, right? As in our previous example, we discussed that if you have already holding a call option and today the price increases, that means you have an option to purchase the asset at a lower price, correct? Not at a higher price. So that means you have saved equivalent to the market price minus the strike price equivalent of payoff to you. Okay, this is the only point that we'll have to remember. And that is where if you see the gain keeps on increasing as the price is also increasing. Clear? Similarly, from a call option seller perspective, if you see, first they are getting an income of a premium equivalent to 5 rupees, but the moment price increases, then they have to bear a loss, right? Because they are going to pay to the call option holder. That is where the loss will start coming and it will be going to be increased once the price also increases. Okay. So what we are saying here that the call option holder is having an unlimited potential to earn. Call option seller is having an unlimited exposure to losses. Okay. Now, put option, we discussed it's a right to sell. If it is a right to sell, then just imagine this situation that today we have purchased a right to sell and tomorrow the prices have decreased. In that case, I will be executing my right to sell through this contract because in the open market, I will not be getting the sufficient return. Hence, in that case, I will be using this contract. The moment I use this contract, I will get a payoff equivalent to the market price, which is a lower amount, versus the strike price, which is a higher amount. correct? So the differential will be paid out to me, and I will go to the market and sell the underlying at a lower price. So ultimately, my realization will be equivalent to the strike price, students. So what will happen here? Here the movement of gain or loss is actually linked to the lower prices, right? The lower the prices, the higher the gain will be, right? Because this is a right to sell. So this is what it is depicted. So till the time price is coming from, let's say, 100 up to 40, there is a constant amount of loss equivalent to the 5 rupees of premium that is being paid. Now after that, there is a gain that will start coming. As the price comes down, there will be a gain. And this is the last situation, students, wherein this is a case of a put option seller. Now, the put option seller will have a 5 rupees of gain up to the point of 45, sorry, 35, right? Or I can say the gain will be maximum up to 5 rupees till the price they have reached 40. The moment price is coming down 40, below 40, the loss will slowly start to get in. Okay, because this is a case of option seller, students. Okay, so these are the four different situations which denotes that as for the call option, as the price increases, the gain for the option holder increases and the loss for option seller also increases. Whereas in case of a put option, as the price decreases, the gain for the put option holder increases and the loss for put option seller decreases. Clear? Sorry, increases. That will also increase. The loss will increase. Okay. I hope this is clear, students. Okay. Now, if we have discussed this, how practically in equity market the buyer and seller will deal, that is on a price. Similarly, on a futures for options, the trading is happening at the rate of premium because the premium is the price of that option, right? Okay. Then let's come to the valuation techniques of the options. Okay, this is very, very important, students. How do you really value a an option, whether it is a call option or whether it is a put option? Now, students, if you see, there are different techniques how you can really value an option. The first technique is called as binomial model. As the name suggests, by means a possibility of two, upper or lower, correct? If there is a possibility of two, that means the entire model is based on two outcomes, whether this will happen or that will happen, whether the price will increase or it will be coming down. For example, we are sitting on 0th day, okay, and the price here is 30 rupees. Okay, and the price here is 30 rupees. Now there are two different possibilities, students. One, the price can go up to 33 or the price can come down to 27. So here the price is increasing by 10%, here the price is decreasing by 10%. Correct? Which is fine. So now in both these cases, what is, and this is 1 year from now or 3 months from now, correct? This is going to be an outcome after some time. I'm sorry. So in this case, it was 3 months from now. The moment we assign these values, we also need to know that what are the probabilities so that these outcomes are achieved. Now, if you see, there were two ways of calculating the probability that we have discussed. One was this, where the probability of price going up was 1 plus R minus D divided by U minus D, where D and U are defined as the proportion of the reduced price and increased prices. this one. And R was the regular rate of interest. However, if there is a case of continuous compounding, then we use this formula. E raised to the power RT minus D divided by U minus D. So this will help you to calculate the probability. Now, using this, we have calculated the probability that it will be 62.5 for the price going up, and the price going down is 37.5, students. Then what we will do, we will calculate the payoffs at each node. So these two are called as the nodes, right? Where the values are defined. So against these nodes, the payoffs will be calculated. How the payoffs will be calculated? If it is a call option, the actual price is higher than the strike price, then there is a payoff. If it is lower, then there is no payoff. Okay. So in this case, the strike price was 28. Actual price is 33. That means 5 rupees was the payoff. Similarly, if the price has come down, the 27 rupees, right? So 27 minus 28, there will be no payoff. It will be 0. Please note, students, it will not be negative. It will not be negative. The reason is we are talking about option. We are not talking about futures. Had we been talking about futures, it would have been negative, right? Because it's a mandatory thing in future. It's an obligation. That's the distinction between the two. So this will become 0. This will become 3.125, and hence the overall number becomes 3.125, students. Okay. And this 3.125 now can be taken a present value, because this is the expected payoffs after 3 months. So what is the current payoff as on today, which is the present value of this 3.125, students. So that will become the present value of this will become your option pricing. Okay. Now we said that there are two ways to calculate a probability. The first way is this one. Now what is the second way? The second way is called as the risk neutral method. Okay. The risk neutral method is very, very important when it comes to even the other parts of the derivatives. Let's understand this concept. So risk neutral method says that you'll have to equate the actual price, which is as on today, to the probability adjusted prices, which is this one, numerator, and take the present value of that probability adjusted prices, because this is after 3 months. What is the probability adjusted prices? Okay. So hence it comes out to be the present value, which we can equate to the current pricing. And this probability can now be calculated. Correct? Because we have assumed the probability as P in this case, which now can be calculated. Okay. So the value of the option is the present value of probability adjusted payoffs. So whatever is the value of the option coming out to be after 3 months, that has to be taken at the present value, which was 3.125. It comes as 3.0487. So the concept is similar, is very simple. In binomial model, it says that there are two ways to calculate a, sorry, there can be only two possibilities when it comes to the pricing of a equity share or maybe any other underlying. One, it might go up, it might go down. Now, in both the cases, we have to find out the probability, and accordingly, we will have to calculate that what is the weighted adjusted payoffs in each cases. Okay. And that amounts we are going to then accordingly take a present value of it to arrive at the today's value of the option. Okay, clear students? Any questions, any doubts, please do let me know. These were the questions around this. I'm moving to the next concept within options itself. One more thing, students. If you see, sometimes the question also asks to calculate, to draw the binomial tree. So what is the meaning of binomial tree? Binomial tree is basically you are basically leading the you're trying to draw into this shape what we have presented on the screen as the different outcomes, right? For example, you're standing on A, so there are two possibilities, B and C. But after that also, again B will have two more possibilities, D and E. For example, up till here, 3 months have been completed. I'm just taking for an example, okay? After this till here, another 3 months have been expired. So this is a overall 6 months binomial tree, wherein up to first 3 months there are two possibilities B and C. Next 3 months for B there are two possibilities. For C again there are two possibilities. However, it's a different case that both B and C are coinciding to the one possibility as a similar possibility. That's the coincidence. Okay. Clear? So this is how the binomial tree is made. Now it can extend up to 1 year also. Let's say 3 months, 3 months, 3 months, and 3 months. 4 times interval it can be there. So it will depend the way the question is drafted or the way situation has been given to us. Yes. Then students, we actually summarized the discussion using these four different cases. Okay. So before we jump to the Black-Scholes model and even the put-call parity theory, we need to understand that these four different cases have something to convey. The case number one, we said that if we are taking a strategy to long a call option, that means we are purchasing a call option, which is a right to buy. This is a right to buy, right? Now, if this is a right to buy, that means if the option gets exercised, we will have to buy the asset at the strike price. We will have to buy the asset at the strike price. Now, if you have to buy the asset at the strike price on expiry, we need to be available with the resources as on today. So what we will do, we will invest the present value of strike price as on today. Okay. So we will invest the present value of strike price as on today. And once the expiry comes, we will take the proceeds out of that investment of the present value of the strike price, which will be equivalent to the strike price now, and we will use those amount to purchase a share. So this is called as, basically this is what we are doing. We are actually devising a strategy. Case 2. In this case, in case we are planning to short a call option, that means we are planning to sell a right to buy. In this case, if the option is exercised, we will have to sell the asset because we are selling the right to buy. If the other person exercises that right to buy, I will have to sell the asset. So if I have to sell the asset, being a seller of the call option, I will have to purchase that asset today. Correct? So step one, again step two. Step one will be shorting of call option, and step two will be purchasing a share today, the similar underlying share today. Case number 3, students. We are taking a purchasing of the put option. In case we are purchasing a put option, that means we are purchasing a right to sell. If you're purchasing a right to sell, that means we also need to purchase a share, because tomorrow, if you're going to exercise that option, we will have to sell the share. So what we will do, we will purchase a share today, students. And the last one was the short of put option, wherein we are selling the put option, selling the right to sell. So that tomorrow the asset can be sold to us. If the asset is being sold to us, I will have to pay the present value of the strike price which I have invested today. I will have to redeem that, and I will have to pay the entire amount to the other person. Okay, so in this case, what we will do, we will invest the present value of strike price today, students. So these are the four different cases. Now we will use some of these cases into the next part. Now, one more point. Option premium is always reflective of the extent to which it is in the money, adjusted for time value of money. So students, till now, you would have been able to make out that if the option is out of the money, that means there is no premium that is going to come, because the option is out of the money, right? It is not fetching any right. If it is in the money, we will have to see what is the extent of in the money, whether it is, let's say, 50 rupees, 60 rupees, 100 rupees, or whatever the case may be, and that present value becomes the option premium. Okay. Yes. Let's come to Black-Scholes model. So Black-Scholes model, students, we will be explaining using the case number 2, wherein we have short the call option, right? So in that case, what we did two things. One, we sold the right to buy, right, which is the selling of right to buy, and corresponding to that, we purchased a share also. The reason to purchase a share, if tomorrow the asset is going to be the option is going to be executed, the right to buy will get executed, and I will have to sell the asset to the person who is executing the right to buy. Clear? So here it comes the right to buy. Okay. So for purchasing a share, we will incur a cash outflow today, which is around 100 rupees, let's say. And by selling the right to buy, which is a writing a call option, I will get on expiry equivalent to the strike price, right? This is what it is fixed for me. If I will have to sell it, I will have to sell it at 90 rupees. That is the strike price. Cash outflow today is 100 rupees. I will have to purchase the share. So what is your, I mean, what is that, if in case we are there, what we will think is that 100 rupees I can purchase something, 90 rupees I will sell something, I will get a 10 rupees loss. This 10 rupees loss I will recover as premium. So hence it becomes the premium. So A minus B becomes the premium, where A is actually the cash outflow today and B is the cash inflow that will happen in the form of a strike price. Now, one thing is very clear, students. Cash outflow is happening today. The strike price will happen on expiry. So what we will have to do, we'll have to take the present value of strike price. So A minus present value of strike price will become the comparable price as on today, and it will give premium as of today. Correct? This is very, very important. For us to know that what is the premium as on today, we'll have to take the present value of strike price. Where now can we rewrite this as premium is equal to A minus present value of B. Now premium of call option, Now A will become what? A was the strike price. Present value of B is the present value of strike price. Now here we are students taking a very inherent assumption which will be wrong, that one share for one option, which cannot be the case. This is never the case. It will be that zero point 0.5 shares for one option or two. Now for that we'll have to calculate the hedge ratio. The hedge ratio will give us how many shares to be purchased, so that is to write a one call option, students. Now premium of call option. Premium of call option is equal to spot price multiplied by hedge ratio. Okay, whatever is the current spot price, that will be multiplied with the hedge ratio minus present value of the strike price. Clear? So spot price we are multiplying with hedge ratio just to give a effect that not only one share will be for one option, one share multiplied by hedge ratio will be the overall purchase amount of the shares. Now, one more thing. We said, students, above that, if the option is out of the money, nobody is going to take that option, or there is no premium for that. Why? Because the option is already not fetching any benefit. So in this case, we will have to also include a factor which will say that on expiry, the pricing will be higher than the strike price, which will be happening through this. So spot price multiplied by hedge ratio minus present value of strike price multiplied by the probability that spot price on expiry is higher than the strike price. Correct? Because if this important element is not there, that means then we are assuming everything to be similar, right? Whether it is out of the money, the situation is similar. Whether it is in the money, the situation is similar. But it's not the case. If it is out the money, it will not fetch any advantage, students. Okay? I hope this is clear. Okay, then if we rewrite this formula as premium is equal to spot price multiplied by ND1. ND1 is basically the hedge ratio. Technically, we denote this as a normal distribution value of D1 minus E into E raised to the power minus RT, which is the present value of the strike price multiplied by ND2. Okay. D1 and D2 being normal distribution value for D1 and D2. Now, D1 and D2, the way they are calculated, sorry, here I hope it is clear that ND2 represents the probability and ND1 represents the hedge ratio. This is the formula, students. D1 is equal to natural log of spot price by exercise price plus R plus volatility square divided by 2 whole multiplied by T divided by V under root T. Okay. And D2 is equal to D1 minus V under root T, students. Herein we were trying to explain that how the natural log function works. It's a reverse of exponential function. That is fine. Now these all values will be available either in the form of additional parts of the question or in the form of a table. Both natural log as well as the normal distribution value. Okay. So by concept, if you see the Black-Scholes model, it's very easy because there is a formula. In that formula, the values can be input and accordingly the result can come. It's just that we will have to input the values basis what it is given in the question. Okay. So this is what I was trying to explain, the standard normal distribution table, wherein we said that area under the curve actually represents the probability, right? And always we have to take from left to right, which is the cumulative amount. So there are different ways an amount can be represented here. So just for all of you, so this standard normal distribution, so this standard normal distribution is actually a distribution. Okay, what do we mean by distribution? Distribution is something which is a collection of data. So this collection of data, if let's say the mean is 10 and standard deviation is 3, any series we are talking about, if you have to convert that into a standard normal distribution, you will have to find out a Z score. Okay. A Z score is a score where you will take your observation for which you're trying to find out the area under the curve, which is let's say 18. From that, you will reduce the mean and divide it by the standard deviation. So that means for a standard normal distribution table, mean is 0 and standard deviation is 1. Okay. So using z-score, we have converted any distribution to a standard normal distribution, and that z-score's value in a normal distribution table we will put in to find out the normal distribution value, students. Okay. Uh, Khalid is asking, please take one practical example of writing call option as per Black-Scholes model. We'll take that. Just after this, we'll take that. Okay. Now, this z-score is actually leading to your mean as 0 and standard deviation as 1, which will help in finding out the normal distribution value. Clear? And there are some characteristic of a standard normal distribution table. If you see right in between, it will split the entire values into two equal parts, 0.5 and zero point 0.5, right? Wherein the mean is 0. Okay. Sometimes the question will tell you that it's a one tail. If you have to convert to cumulative, we will have to do 1 minus one tail. That will convert it to cumulative. Similarly, for two tail means first we'll have to divide by 2. It will arrive at a one tail. And from that, we'll have to go 1 minus one tail to arrive at the cumulative. So these are very easy things. I mean, in question itself, we'll be able to see. And this was the property which I've explained in the last class as well, in the last session as well, wherein for the initial margin and maintenance margin, remember we were trying to identify you. So what is the initial margin, right? So that was mean plus 3 times standard deviation. So therein I explained that 99.7% of the transactions falls between these two grades. Mean minus 3 times standard deviation and mean plus 3 times standard deviation. Now this is an example. Okay. So let's see this. From the following data for certain stock, find the value of a call option. So here they are asking us to calculate the value of a call option. What all things they have given? Price of the stock now. This is the spot price, students, right? Spot price is 80. This is the exercise price. 0.4 is the standard deviation of the continuously compounded annual return. Please do remember this is for the continuously compounded annual return rate. Maturity period is for 6 months. Annual rate of interest is 12%. Given number of SD from mean, which is the Z score, students, right? Number of SD from mean, which is Z is equal to A minus mean divided by SD. So this is for the Z score they have given. Area of the left or right, this is their what they've given as one tail. We will have to convert to cumulative by doing 1 minus one tail. That will give you the cumulative amounts. Okay. Now, let's calculate the value of the call option using the Black-Scholes model, students. First, we'll write the formula simple. Spot price multiplied by ND1. Spot price is we are taking because we will have to purchase the share today at the today's price. ND1 will answer that how many shares have to be purchased minus strike price multiplied by the present value factor to arrive at the present value of the strike price. And lastly, ND2, which is the probability that the prices on expiry will be higher than the strike price. Okay, so these are the different elements. Now, D1 is actually denoted by natural log of S by X plus R plus volatility square divided by 2 into T. So, this is a standard formula, students, for D1 and D2. Okay, now if we calculate the natural log of 80 by 75, 80 was the spot price, 75 was the strike price, is equal to natural log of 1.0667. This was given in the question 0.0646. Okay, we will just take these values 0.0646. Okay, and then we will put it in D1 0.0646 plus these all things have to be annual, because already with time we are multiplying later on, which is 6 by 12. Okay, so 12% and 0.40 have to be the annual metrics. Clear? So 12% and 0.4 have to be the annual metrics. Basis that number we will put into the D1 to arrive at the overall value. Okay, now if you, it's just a simple formula calculation for D1. So the D1 comes out as 0.5820. And similarly, we can calculate D2 here. Yes, 0.5820 minus 0.2828 to arrive at this much. So ND1, which is 0.5820, and ND2, which is 0.2992. This is what we have arrived at. Then number of SD from mean that is given to us. One tail is this much, two tail or the cumulative will become this much. Sorry. Correct. So the cumulative one will become 1 minus 1 tail. Now, if you see, students, we have been given 0.25 and 0.30. However, we have to find out an in between value. And similarly, for the ND1, we have been given 0.55 and 0.60. So for that also, we'll have to find out the 0.5820 value. Okay. So in both the cases, we have been given two different values for an outer and a lower limit, and we have to find out a value in between. So for that, what we will do, we will use the interpolation technique, students. Okay, using the interpolation technique, we will be able to find out a value in between. Okay, so using this interpolation technique, you can see we take the lower value, then the difference between the outcome divided by the difference between the input and multiply it with the difference to arrive at the 0.5820's value. Okay, then similarly ND2 was 0.6176. Okay, so ND2 basically represents that the probability on expiry will be that actual price will be higher than the strike price. So there is a 61.76% probability that it will be higher. Similarly, for ND1, 71.97 percentage of shares to be sold for one option. Clear? So this is what the relevance of the ND1 and ND2 is. And then just simply we'll have to put the numbers into the formula. Spot price 80, Present value of strike price 75 divided by e raised to the power 0.12 into 6 by 12 because it's a 6 months period. ND1 hedge ratio, ND2 probability. Okay. And hence the value of the call option becomes 13.95 students. Clear? Then let's come to put options, students. So put options is under the Black-Scholes model. Again, we will be using the case number 4, where we are selling the put option, which means we are selling the right to sell. And in that case, we will have to, in case we are selling the right to sell, if the other person is actually executing the right to sell, then that person will be selling the shares to us. Okay. Now, this is how we have discussed this, that there will be a cash outflow to the extent of the strike price, right? This is what we are going to do. And the today's cash inflow of the spot price will be invested. Okay. So let me come over here. So today what is happening from a option writer perspective, that the right to sell of equity share after 3 months, the option holder will be purchasing that option, right? That option of right to sell. Now, what will become? This option writer will become after 3 months. This person will become the purchaser of the equity share, right? And the option holder will become the seller of the equity share. And hence they will receive cash. Here it will be a cash outflow to the extent of the strike price. So in other words, the value of put option is given by this formula. Now let me explain through this. So x divided by e raised to the power rt, this is similar to the present value of the strike price, multiplied by n minus d2. So if nd2 was the probability that the strike price will be higher, probability that the actual price will be higher than the strike price, and minus d2 is the probability that the actual price will be lower than the strike price. Okay, clear? Similarly, minus spot price multiplied by n minus d1. Again, for one option, how many shares? This will answer the question. Clear, students? So this is just a opposite formula of the call option that is used in the put option. Now, till now, students, we have discussed about the forwards, futures, and options, their concepts. So first of all, we have discussed that what do we really mean by a forward or a future or an option. We have also discussed about the hedging part, right? That using these derivatives, how we can hedge. Hedge means already there is a risk that is there in the underlying, and using the forward futures and options, we are trying to reduce or mitigate that risk. Then the third part is around the valuations. Around valuations about the futures and forwards and options, there are two parts, right? One, futures and forwards, the concept of the present value and the future value prevails, right? That is using the compounding technique. In case of an option, the binomial model we have discussed, risk neutral method we have discussed to calculate the probabilities, and then the Black-Scholes model for two different formulas, value of call option and value of the put option, students. I hope this is clear. Any questions, students? Let me take a pause before we move to the put call parity theory. Okay, Khaled, I think we have discussed this. Do you want me to take any other example of a call option writer? So, see, example is this only. I mean, we can. I think Khalid, I have a question. So, first of all, we need to understand that this call option can be written on any share. Okay, it can be on any equity share that is operating. So, if you see in the, let's say, futures and options segment of the stock exchange, the options are dealing, or the options are getting traded. Now, the call option writing will mean what? That I'm selling the right, that I'm selling the right to buy, or I'm selling the right to sell. So, in case of a call option writer, I'm selling the right to buy because I feel that tomorrow the prices are going to go down. That is what I feel, right? That's where I'm selling the call option. The moment I sell a call option, I will receive a premium. Now, that premium will depend on the different valuation models that we have discussed, whether it is a binomial model or whether it is a Black-Scholes model. So, basis that the market will adjust the actual premium that can be paid around these instruments, and accordingly the value will be received. Let's say if I'm a call option writer, now I am having a risk. Now I have undertaken a risk. Now today, now tomorrow, if the prices actually goes up, in that case the option will become lucrative and I will end up paying more amount into the payoffs. Okay, and hence I will not be in a beneficial position, students. Okay. Now let's come to put call parity theory, students. So Khalid, how would it matter whether it is Reliance or Tata? I mean, I said that it can be on any company. It can be on any equity share. Okay, Khalid? The concept will remain same, whether it is Reliance, whether it is Tata, or whether it is anyone else also. So the concept is that I am selling the right to buy. Okay, and I'm receiving premium against that, and I'm undertaking a risk that tomorrow if the prices goes up I will have to bear the loss. So that's the entire premise, Khalid. Okay, let's come to put call parity theory. Put call parity theory is actually based on case number 1 and case number 3, students. Okay, what are those two different cases? Wherein we are purchasing a call option and we are purchasing a put option, right? So herein what we discussed, we said that okay, let's take two different situations, one in call option and one in put option. The strike price, we said that okay, we'll keep it as 180 for both call and put. Spot price currently is 150. So the premium of the call option is around 15 and put option is around 10. The rate of interest is 20% per annum and time period is 1 year. So the initial cash flow, students, will happen around what? So case number 3, okay, which was purchasing a put option. If you purchase a right to sell, that means you'll have to also purchase a equity share today. Because if I'm purchasing a right to sell, I will have to sell that asset tomorrow, right? So I have purchased at 10 rupees by paying premium. That is the put option premium. And 150 rupees I have paid it as a spot price. So in totality, we have 160 rupees that we have paid off. These are the initial cash outflows. Then, in case of a put option, if I'm purchasing a put option, I will purchase it at the premium of 15 rupees. And if I've purchased a right to buy, I will have to invest the present value of strike price today so that I can pay that amount tomorrow to receive my shares. So that is 180 divided by 1.2, which is 150 rupees. 180 is the strike price, 20% is the interest rate. It is 150. Okay. So this becomes minus 165. Okay, Khalid. Khalid is saying, yeah, but when I calculated, then the premium doesn't match with it. But what assumptions have you taken, Khalid? What volatility rates you have taken? Have you taken the rate of return as per what it is appearing in the market or what is specific to you? Right? So there are many things, right? How do you take the parameters, what you take? Then how have you arrived at uh, the other parts of the Black-Scholes model, right? So, and then the last thing will be everything is not theoretical in market. This is a theoretical minimum price that is getting calculated using the formulas. Even the practical aspects of demand and supply also will come into the play, which is not factored in into these formulas. Okay, so there are many things that will come practically to calculate. Okay, but more or less, if you see, if you take the strike price and compare it with the spot price, take out the difference, the premium would be around that only. That is there in the market. Okay. So let's come back to this put call parity theory. In two different situations, the first situation outflow is minus 160, second situation outflow is minus 165, because both the situations there are different portfolios getting built. Then what will happen? Subsequent cash flows after 1 year. Let's say the price becomes as 200 on expiry. Then the investor one, okay, that person has purchased a put option. What is the strike price? 180. Market price is 200. So the put option will become out of the money and it will not be executed. However, the shares will be sold at 200, right? Because that person is holding the equity share already. So that 200 will be sold, nil will be the value that will be received from the option, and overall, there will be a value of 200 rupees that will be received. Investor 2, in case the price becomes 200. Remember, investor 2 has purchased a call option. Call option will become beneficial if the prices goes up. So 20 rupees will become the payoff here, right? And the present value of the strike price, what is invested, it will be received as a maturity proceeds at 180. So that will become overall 200 rupees as cash flow. So students, have you noticed that for both the investors, the overall cash inflow after 1 year is 200 and 200 in both the cases, students, right? It has not changed. However, initially the amount was different, 160 and 165. So let's do one thing. Let's take another example of the another price so as to prove our theory. Now, in this case, let's take an example of 100 rupees. So if it is 100 rupees, the put option will become in the money by 80 rupees. Why? Because 180 is the strike price, 100 is the market price. So that 80 rupees becomes the payoff. So the put option value is in the money 80 rupees. Shares will be sold at 100 rupees. So in totality, this person will get 180 rupees. Now, if we talk about from a call option holder, the strike price was 180, market price is 100. It will not be considered. It is out of the money, right? Zero is out of the money, and this 180 will be realized on maturity using the present value of the strike price. So overall, we will get 180 rupees. Okay, net cash inflow after 1 year. So if you see, students, here also 180 and here also 180. So just to summarize, whatever price occurs in the market later on, this is for investor 1 and this is for investor 2. Initial value was 160 and 165 here. Here it becomes 200 and 200 and 180 and 180. So if you see, the subsequent value is similar, right, across both the investors. So in all the situations, if it is coming similar, then why there has to be a difference in the initial value? So the initial value will also be corresponding to the similar thing. Now in this case, what will happen? the demand for investor one's portfolio will increase, because by investing 160 rupees, still you are able to make out the same amount of money which 165 rupees person who is also investing, right? So the demand of this will increase and the demand of this will decrease. The moment it will happen, it will increase the value of put option, because investor one has purchased put option, and here it will decrease the value of call option. So this will increase or decrease by the demand and the supply side. The moment it will happen, the investor one, people will, the situation one, the people will start investing more, and hence both of them will become equal due to the market forces. So let's say it will become minus 163, it will also become minus 163. So the market forces will bring them at a equal level. Reason being because the subsequent cash outflow is similar, and hence we have equated both the investor 1 and investor two's related portfolios as equal, which is value of the put option plus spot price is equal to present value of strike price plus value of the call option, students. I hope this concept of the put call parity theory is clear. Let me just take a pause and check. Okay, I hope it is clear. So the put call parity theory says that the put option and call option, both of them are related to each other with the changes in the equation, wherein in put option if you add spot price and in call option if you add the present value of strike price, both these situations will give you the similar kind of an cash flows. So hence the overall value becomes equal. Okay. Then student, we would have discussed about the questions, the put call parity theory. So now where you can use the put call parity theory, the question comes that. So the put call parity theory can be used. Okay, let the screen change. So the put call parity theory will be used wherein at one place you are having a put option and at the second place you are having a call option, and let's say out of these four parameters which are part of the put call parity theory, which is the value of put option plus spot price is equal to value of call option plus the present value of strike price. So out of these four elements, if any one of them is missing and rest three are given, it can be used to calculate the missing part. Okay, here. Now let me see what is next here. Yes, Greeks. So now let's have a discussion around Greeks. Greeks are some of the factors that affect the premium of an option, right? So these are what students typically, we have already discussed. These are the spot price. These are, let's say, the time value, right? This is the volatility part. So all these factors are covered as part of Greeks, which affect the pricing of the option. So the first one is called as the hedge ratio. Hedge ratio is what? Hedge ratio is basically the delta. Delta is what? Delta is change in the value of a call option divided by the change in the spot price, students. If you see this, change in the value of call option divided by the change in the spot price. If in case of call option, if the spot price decreases, the value of the call option also decreases. If the spot price increases, the value of the call option also increases. There is a direct correlation. In case of a put option, if the spot price increases, the value decreases. And if the spot price decreases, the value increases, because lower the value in case of a put option of the share, higher the payoff will be, right? So a delta is measuring the extent of change. What is the extent of change? Call option, it is called as ND1. Put option, it is called as minus N minus D1. You remember from the from the Black-Scholes model, ND1 is the hedge ratio. So the hedge ratio is called as delta. Okay. Now, if we talk about call option from a buyer perspective, okay. So the option was out of the money till here, then at the money here, and then in the money. So what will happen to delta? Delta is zero when the option is starting from deep out of the money and slightly increasing from 0 to 1. While the option moves from deep out of the money to deep in the money. So what happens? So here the delta is 0 and here the delta becomes 1. I'm sorry. Okay. And it increases from 0 to 1 as the price keeps on increasing. Clear? So the slope of payoff line is called as delta. Clear? Delta moves from 0 to 1 as the stock price increases. Now put option, delta moves from 0 to minus 1, right? As the stock price decreases. If you see, this is the part here, because the prices are getting decreased, but the payoffs are getting increased. That is where the slope is minus 1. Clear, students? And put delta is equal to call delta minus 1, students. So this is also a relationship that needs to be remembered in case we want to move from put delta to call delta or call delta put delta. This can be used. Now the second part is actually gamma. Now gamma measures the rate of change in delta when the underlying price changes. So delta measures the change in the value of the call and the put option with respect to price. Gamma is the delta of delta. Are you able to make it? So it is measuring the change in delta, that is called as gamma. So if it is at the money, it is highest. Deep in the money or deep out of the money, it is low. Right? So the change of delta is happening slowly. But if it is at the money, if you see, the change in delta will happen very fast. Okay. So gamma is equal to change in delta divided by the change in spot price, students. Vega. Vega is actually measuring the sensitivity of option price to the changes in volatility. As we discussed, students, right? Volatility also plays a major role, because if you see, the volatility is high, the risk of an outcome is also very high, right? The risk is also very high. So that will lead to what? That will lead to the higher risk expectation and higher return. Similarly, if the risk is lower, the return also will be lower. So that is Vega. Then comes Rho. Rho means the sensitivity of option price to the changes in the risk-free rate of return. This is called as Rho. Rho means the risk-free rate of return. If the time value is okay, so if the risk-free rate of return is higher, the present value delta and the future value delta will also be higher, right? Because the present value will be happening at a higher rate now. So if the rate is high, the call option premium will also be high, the put option premium will be low. Similarly, if the rate of return is low, call option premium will be low and put option premium will be high, students. This is from the rose perspective. Theta. So the way theta is basically the passage of time. As the time passes by, the what is the sensitivity of option price, right? Obviously, the sensitivity of the option price will come down because the present value factor will also keep on reducing. Okay. So Greeks, finally, what all things we discussed? Delta, which is the change with respect to spot price. Gamma, change in delta with respect to spot price. Then veg, rho, and theta. Vega is volatility, rho is rate of interest, and theta is the theta is the time. Okay. Now, students, let's discuss about the credit derivatives. So, credit derivative, students, is basically covering the risk of a credit. So, till now, you have seen the derivatives that we have spoken about is covering the risk of market, the risk of prices, right? But credit derivative means that there is a risk of counterparty not being able to pay us the amount. So, that is also a risk. And credit derivative is trying to answer that, right? So this is what we've already discussed. Market risk, for example, prices, interest rates, stock market, and exchange rates, right? Forward futures and options are used for that. Credit risk is basically the non-payment risk, which is also called as the counterparty risk, which is, let's say, the non-fulfillment of the obligation by the counterparty. So there are different types of instruments that are used for this. So the first one is collateralized debt obligations, CDOs. These are called as CDOs. So students, you would remember in our securitization topic, we discussed about an originator, a borrower, SPV, and investor, right? Originator is the one who will originate the transaction, who will sell the assets to SPV. SPV will issue marketable securities to the investors, and borrowers are the one who have borrowed money from the originator in the form of a mortgage loans. So here we discussed about two things, right? Mortgage-backed securities, which is MBS, and asset-backed securities, which is ABS. So what did originator did? Originator actually sold to SPV, right? And SPV is actually issued in to the investors as mortgage-backed securities. Now here, 80% of the borrowers are okay, they will pay on time. 10% of the borrower interest payment was defaulted, and balance 10% borrowers, both principal and interest payment was defaulted. Okay. Now, what has happened? There are different risks attached to the different borrowers, right? Some of them are okay, some of them are having a risky situation. Now, what was happening here? There were three different tranches, right? It formed into three different tranches: senior, mezzanine, and equity. Now, what was the purpose of creating three different tranches? One, if there is a fixed return without risk, right? Let's say these are from the point of view of investors, students. Okay. So, as an investor, if you are a senior investor, you will get fixed return without any risk associated. So, if these 10% guys defaults, you will not get any hit out of that. Mezzanine were the ones who were at medium, who were having a medium risk and return, but they were having a higher return of 6%. And equity, which was high risk and high return, let's say they will get 10%, but if tomorrow there is a risk of non-payment, then they will have to bear it. So you feel that there are different tranches, there are different ways to deal with these risks. This is called as collateralized debt obligations. Okay, the creation of different tranches into that securitization process to come up with the homogeneous group of senior, mezzanine, and equity is called as tranches. Now, CDOs can be of different type. One is cash CDO, second is synthetic CDO. Cash CDO is basically where the cash moves away from the balance sheet. Sorry, the receivable moves away from the balance sheet and cash comes in. But here, only the credit risk is transferred. In synthetic CDO, still the receivable is sitting in your balance sheet. Credit default swap. This is the second form of credit derivatives. Credit default swap means credit, which is a loan. Default means there is a non-payment, and swap means exchange. So what is happening? There is a protection buyer and there is a protection seller. So protection buyer will pay premium to the protection seller at the rate of 0.5% of the loan amount. Any default on the reference obligation. So this protection seller will make good that default. For example, the insurance companies, right? They are just like insurance companies. Now, in this case, there can be two different types of settlement. One, physically, all the bonds and deliveries, etc., are settled, or second, only the differential payouts are settled. Okay. So credit default swap means what? That we are actually assigning the risk of non-collection to a insurance company, and we are paying a premium for that. Tomorrow, if there is some default that has happened, that insurance company will pay us the amount of that default. Okay, clear? I think then we would have discussed all these MCQs in the session. Yeah. Then let's take another, sometime on the real options as well. So, students, till now we have discussed about the financial options, right? We discussed about the derivatives which are having a financial asset, financial instrument as an underlying. But real options is a concept where the underlying is a long-term project, which is a capital budgeting project. Now, it will mean that there is a variability in cash inflows and cash outflows, right? Variability means that that actually you are not able to determine whether the specific amount will be an outcome or not, and even the time period for that matter. Okay, let's say initially you assumed that 15 years there will be a time in which we will complete the project, but there is a risk that out of that 15 years, let's say the project would have went beyond 15 years, let's say 20 years, right? So similar to a call option where it gives a right to buy and a put option where it gives a right to sell, right? So call option for a real option will become right to invest. That means you have a option to invest now. So for example, you are contemplating whether you should invest today or whether you should invest 1 year from now. So that is a call option if you want to invest 1 year from now. Right to disinvest is basically right of yourself to come out of that project is called as right to disinvest. If you plan for that, this is called as a put option. Let's say today you are sitting and today you say that okay, after 5 years I will disinvest from this project because I feel the real value derivation has already happened. But what will you do? You will not, you will also evaluate other options, right? So there can be a one option that instead of 5 years you should disinvest in 6 years. So if you purchase this or you will have a put option with you, that means you have a right to disinvest after 5 years or 6 years, the way you want to decide. Now, students, all of us know that capital budgeting, the foundation of capital budgeting is discounted cash flow method, right? DCF. Now, financial options, we discussed that underlyings are these shares, stocks, bonds, commodity traded in the market. Real options are the projects that are not traded in the market. That means these are over the counter contracts. Here the payoffs are fixed, here the payoffs are variable in real option, because in real option the variable payoffs will depend on lot of factors, right? What is the period? Here it is a short period up to 1 year, and here it is a long period more than 1 year as well. And we call this as a pricing, and we call this as a value, right? What is the value of this capital budgeting project, right? Now, long call means there is a right to invest at a future date at a certain price to enter into a business, to expand a business. That is called as a long call. That means right to invest. Long put means right to sell at some future date at a certain price. That means right to abandon or right to disinvest at zero or at a certain price in future. Short call, a commitment to disinvest upon the action of the counterparty to the call option. This is what we do in case of a short of a financial call option, right? If it is there, if it is the case, then we will have to honor the commitment by selling the asset. And here it is that we are disinvesting the asset. Short put, a commitment to invest upon the action of the counterparty to the put option. Clear? Option holder. Option holder is the one who is having the right to invest, and option writer is the one who is having a commitment to disinvest, right? And similarly, for put option, there is a right to disinvest and there is a commitment to invest in case the counterparty feels so. Now, in terms of valuation, risk neutral method and binomial method are used. Black-Scholes model are not used. Then there are different types of real options. I'm not covering that in the. So these are the questions that we would have discussed around the real options. Wait, let me just see. Yeah. So students, let's do one thing. Let's quickly do the case studies as well, which is related to the derivatives. Okay. So I'll be covering this part. Let's take the case study one. Yeah. I hope, yeah, this is visible. Perfect. So case scenario one, let's take that. X and Y are two friends. Since Y has earned a lot of profit from trading in financial derivatives market, X is also considering speculating on Gamma Corporation's shares, which is currently trading at 700 per share, through taking positions in the options in the stock of the same company. Sorry. So accordingly, X took following contract positions in the options on the Gamma's corporation stock. Now, if you see X and Y, there are two different individuals. Y has already earned a lot of profit. X is into the planning phase. Now, X, what they will do, they will purchase. X have purchased one contract of 2 months call option with a premium of 35 and exercise price of 750 students. Okay, so let's write it. Premium. So we are talking about value of call option 35, exercise price of 750, and value of call option purchasing 2 months put option. Sorry, value of put option. Another put option is with a premium of 25 at a exercise price of 600. Exercise price of 600. Clear? So they X have purchased both the options. Currently, the share were trading at 700. That is also mentioned. 700 per share through taking the positions in the options, right? Then, after some time trading in the option market and understanding the nitty gritties of same, X being CEO in an organization advised his team to implement the concept of financial options in capital budgeting decisions called real options, right? This is what we just now spoke about, right? The real options, which have capital, budgeting, projects as underlying. Okay. Assuming that the contract size of each option contract is 100 and the price of Gamma Corporation's share after 2 months falls to rupees 550, the net payoff of X will be. So they are saying that the contract size is 100 and the price falls to 550. What is going to be the net payoff? That we can calculate. Contract size, contract size is 100 and price 550. Put call. We are talking about call option first. The exercise price was 750. Now come on students, tell me, if the call option is there, the exercise price is 750. So the payoffs will be nil here, right? And second case is for put option. If the exercise price is 600, in this case 50 rupees will become the payoffs. Correct? 50 rupees will become the payoff. So contract size is 100, value will become nil here, and here it will become 5000. So in totality we have received 5000 less premium. On 100 size we would have paid 35 rupees as premium for call option, and put option again on 100 for 25 rupees we would have paid premium, right? So this is 3500, 2500. This is all going to get reduced. So minus 1000 rupees becomes the payoff. So 1000 rupees of loss. This is the right answer. Clear, students? The price per share of Gamma Corporation's stock after 2 months at which X shall be at break even is. Now they are asking about the price at which the X shall be at break even. For breaking even, we have to find out that what is the overall amount. So this is for the second part. Okay. Now for breaking even, students, we'll have to first find out that what is the overall amount that we have paid, right? So we have paid 35 rupees as the option premium and 25 rupees as the option premium for both put option and call option put together. What is the price overall? This is 60 rupees. Now, what is the original price now? Now there are two ways to it. If let's say, now there are two ways to it, okay? There are two possibilities. One at an exercise price of 750 and an exercise price of 600. Wait. So 60 rupees is the amount that we have paid. Now, if we take a 750 rupees, then 750 was the call option exercise price. That means 810 should be the actual price, so that through call option we can make a gain. If we talk about put option, so this is for call option. If we talk about put option, then exercise price is 600. From that, if we reduce 60, we arrive at 540. So the actual price, if it is 540, then also we gain, right? So there are two possibilities. Let's see which one is given. Is 810 given? No, but 540 is given. So 540 becomes the right answer. Okay, clear? And the last part, which of the following statement is false regarding real options? Any doubts, students? Any questions till now? Please do let me know. Okay. Which of the following statement is false regarding real options? Real options methodology is an approach to capital budgeting that relies on option pricing theory to evaluate projects. Okay, this is the first part. We have to, please remember, we have to identify the false items from this. Real options approach is intended to supplement and not replace capital budgeting analysis based on the standard discounted cash flow methodologies. Real options are different from financial options as their period starts from the end of the first year and are higher than the financial options. And last, real options are normally traded in the market and are priced. Now, students, if you remember, we said that the real options are not traded in the market. Reason being, they are highly customized. They are highly customized. They are for a specific project, right? A capital budgeting project. The only dealing in the market can happen in those situations wherein the contract is a standard contract, students. Okay, since this is not a standard contract, this cannot be traded on a market, and hence D becomes the wrong answer. I mean, the D becomes the false answer. Rest all places, if you see, is an approach to capital budgeting that relies on option pricing theory. This is true. Real options approach is intended to supplement and not replace capital budgeting, because it's actually supplementing the entire calculation. It's not replacing. Real options are different from financial option as their period starts from the end of the first year and are higher than the financial options. Yes, because the financial options are up to 1 year, real options are more than 1 year, students. Okay. So this was the case study number one, students. We have other case studies also. We will cover that. Let's break for 10 minutes. We will again reconvene and cover the balance part. Thank you. Okay. So students, welcome back. So till now we have discussed the revisionary aspects on derivatives. Um, Let me see. First, we should do the revision on 3, 4, 5, and 6. Okay. So let's do one thing, students. Let's quickly do a revision on the interest rate risk management as well. And then we will come to the questions directly. Okay. Then we will wrap the discussion. So we are covering the concepts of the interest rate risk management as well. Okay. Then we will do all the questions put together. Sorry. So students, in case of derivatives, we have discussed about the forwards, futures, and options, which are covering us for majorly the market risks. Now, market risks were typically of what all types? One, the pricing. Second, the interest rates. Third, commodity. Right. So all those were the different examples. Now, in this specific topic, we are going to discuss about the interest rates, right? Because the market interest rates are volatile, they are not fixed, they are bound to change. Now, with that, there is a risk that what interest rates we thought basis those interest income and interest expense we are incurring might go and underchange. Okay, so hence this is the context of the topic that we are going to discuss. So interest rate risk management, students, if you see, there are two terms in this. One is interest rate, second is risk management. So interest rate means that since the interest rate is not fixed, it is volatile, so we are referring to that. Risk management means that we don't know what is going to be the outcome. It can be on a positive side, it can be on a negative side. So if it is on a negative side, how do you manage those situations? Okay. So first of all, why do we pay an interest? Let's try to understand that. We are starting from a very basic thing, that why is there a need of an interest? The interest is paid for two different reasons, students. One is time value of money, which is inflation, right? Because 100 rupees of worth of goods today, the standard basket today, will not be equal to what will be after 1 year. So there is a inflation element attached. There is a time value of money attached, right? Because the money will not be having a constant value as on today and 1 year from now. That is the first reason. If I'm lending someone 100 rupees today, it will have a value of 110 after 1 year. That is why I will expect 110 rupees. Second reason why interest is charged is the risk of non-payment. The risk of non-payment is the risk where there is a counterparty risk. Okay. In other words, let's say Mr. A has lended amount to Miss B. Now, Miss B will repay it back or not, will actually have a risk on the bearing of Mr. A's amount that they have given. Clear? So, because there is a risk of lending, hence Mr. A would expect some amount of interest. Let's say overall Mr. A is charging 10%. Out of that, 8% can be attributed, let's say, to inflation, and 2% can be attributed to the risk. So in totality, Mr. A is charging 10%, 2% on account of risk, and 8% on account of the time value of money, students. Clear? And for risk also, we are charging a consideration because we have undertaken a risk part here. Okay, students? Now, this is the concept on inflation. 100 rupees today will become 120 rupees after 1 year. That is what is called as the time value of money. Now, the primary concept is interest rates are not static, they are dynamic, they are bound to change. And why they are bound to change? Because one, market forces of demand and supply of credit. Second, RBI's intervention in policy rates, right? That keeps on changing the policy, the interest rates. So all these situations leads to the different interest rates. Now that is where it leads to the interest rate risk. Correct? The risk is that there is a change in the interest. Now, interest rate risk changes impacts the financials of the company. So we are going step by step, right? First of all, we define what is interest. Then whether interest is static or dynamic, it is dynamic. If it is dynamic, it is posing a risk. Now that risk is posed in the form of different outcomes. Now, if there is a risk that will impact the financials of the company, imagine someone have given a loan, right? Someone have given a loan and suddenly the interest rate falls. The realization of the interest will also fall. It will impact the P&L of that company. Similarly, someone has borrowed and the interest rate have increased and it's a floating rate borrowing that has happened. So the moment it has increased, it will lead to the higher interest expenses on part of this person who has borrowed the amounts. Okay, so that is where the interest rate changes impacts the financials of the company. Now, hence it becomes very much important for us to hedge against those risks. Now, what are those risks? One is the traditional method. What are those methods? One is the traditional method, and second one is the modern method. Traditional method specifies asset liability method, ALM method, forward rate agreement method, FRA, which is called as forward rate agreement. Then modern method is actually interest rate futures, interest rate guarantees, and interest rate swaps, which is the swaps. Okay, we will cover each and every method detail in now. So the first one, students, is the asset and liability method. Okay, so the asset and liability method is the method in which, so if you see a balance sheet of a company, right, some of the assets will be realized at some point in time and some of the liabilities will also be paid off in some point in time. Asset liability method is basically matching the timing of cash inflows and cash outflows according to this. So the timing, if it is matched, then there is no need to borrow amount or surplus funds which has to be invested. Sorry. Okay. Then the second one is called as the forward rate agreements. Sorry, which is called as FRA. Okay. Now there is a way to denote it. We will come to that. Let's first explain what is the concept really means. Now let's say there are two banks, Bank A and Bank B. Bank A needs to borrow after 1 month for 3 months, rupees 1 lakh. Now if you see, the expectation is to borrow after 1 month for 3 months, rupees 1 lakh. Today there is no need to borrow, but after 1 month. And bank B needs to invest for 3 months. After 1 month, similar amount of 1 lakh. So bank A and bank B have similar kind of time frames in which they want to borrow or invest. Current interest rate is 5% per annum. You think it from bank A's perspective. If the interest rate is going to go high, that means the bank A will need to enter into a situation as of now. And bank A says that, okay, to bank B, that after 1 month, I will borrow 1 lakh from you at the rate of 6% per annum. Whatever is the interest rate appearing in the market as on that date, I will ignore that and I will just pay you 6% per annum for that 3 months of borrowing that I will do. Bank B also assesses this deal at its level and it concludes that it is okay to enter into a deal. Why? To keep it as open, right? So in a way, they both have agreed to 6% per annum, which is the agreed rate. So they are able to mitigate the risks of any adverse movements in the interest rate changes. Clear? So for example, we are sitting on 0, 1. So on today, the deal will get committed. Deal commitment is happening today. Deal execution will happen here. After deal is executed, for 3 months, the deal will be operational, and after fourth month, the deal will be over. So this is denoted by FRA 1 by 4. So 1 means after 1 year, after 1 month, the deal is starting, and it will go up to fourth month from today because the duration is for 3 months. So if we reduce 4 minus 1, we will get the duration which is 3 months. Clear? So this is the standard way to denote the forward rate agreement. So the concept is pretty simple, that there is a need to borrow or invest, but that need to borrow or invest is not as on today. It is after some time, and hence there is a need to enter into a commitment so that it, sorry, and the rate is also agreed, correct? The rate is also agreed at 6% per annum, students. Clear? So FRA 3 by 6 will mean what? The duration is for 3 months, but the starting point is also third month from now. FRA 12 by 18 will mean what? That the starting point will be 12th month, but the duration will be for 6 months, which is 18 minus 12, students. Okay? Clear? Now let's come to the payoffs between these two banks. Now let's say bank A is the one who is in the borrowing position, and bank B was the bank who is into the lending position. So 6% is what they have agreed on the 0th period. Now after the first period, let's say the actual interest rate is 8%. The interest rate have become higher. Now see how bank A will think. Bank A will say that, okay, after 1 month, we are standing after 1 month, the actual rate in the market is 8%. I have a commitment from bank B where bank B will give me funds at 6%. So I am having 2% lower amount. So that means I am having a gain of 2% compared to what it is there in the market. So it is very much similar to a long forward, right? Purchase of a forward, wherein that person who has purchased the forward will gain at the rate of the difference between the actual market price minus the strike price. Okay. So actual interest rate is 8%. There will be a gain of 2%, students. On the similar side, from bank B's perspective, bank B will say that, okay, I have given a commitment to lend amount to bank A at the rate of 6%. However, in the market, I could have invested at 8%. So there is a 2% loss that I have incurred. Hence, from bank B's perspective, there is a loss that will come into the picture. Right? Now, the second case, if let's say the actual rate is 5.5% after first period, then the bank A will think, in the open market, I am getting this at 5.5. However, I have a commitment to borrow at 6%. So zero point 0.5 I will have to pay extra, right? So that is my loss. So zero point 0.5 becomes my loss. And bank B will say that in the open market, I could have invested at 5.5. But due to this, I'm getting a higher rate of 6%. I'm investing at 6%. So zero point 0.5 becomes my gain. So I hope students you are able to make it out which situation is better for bank A who is into the borrowing side, and which situation is better for bank B who is into the selling side. Clear? I hope this is clear, students. Perfect. Now, there are two ways how it can get settled. One, bank A would get 2% and bank B would pay 2%, which is the differential amount, right? On 1 lakh, which is the notional amount, 8 minus 6, which is 2% for 3 months. This is the value after 3 months. So, this will be taken at a present value for 3 months, and 490.19 can be taken up after the first period by this bank. Okay, so 490.19 will be paid by bank B to bank A on the first month end, right? After the first month end. Option 2, bank A will pay only 0.5 and bank B will receive 0.5, which is the 5.5%. So in this case, 1 lakh 6 minus 5.5, again the present value of that. Please do remember, students, present value will always happen at the actual rate, not at the agreed rate. Okay. So this 123.31, bank A would pay to bank B because it's a loss for bank A. In the second situation, it was a loss for bank A for 0.5. Clear? So what is happening, students? The differential amount is getting calculated, but that has to be arrived at a present value of once the FRA is executed. On the day of execution, the present value is calculated and then only the amount is paid or received by the respective individuals. Okay, clear? So this is all about FRA. Now in this, we have already covered the formula as well, students. This was the formula, right? The notional amount multiplied by the required rate minus forward rate into time period divided by 1 plus. So RR is actually the actual interest rate multiplied by T. And from a borrower's lens, we call it as the purchasing of FRA. And from lending side, this is called as the selling of FRA, sold FRA. Bank A is the long position, bank B is the short position. Interest, there is a, if the higher the interest, the higher the gain. Lower the interest, the gain will be lower or there will be a loss. Similarly, for bank B, if the interest is higher, the gain will become lower, and the interest is lower, the gain will become higher. It's a opposite relationship for bank B, which is into the lending position. Bank A, who is the borrower, is having the long position in the FRA, have the direct impact. Okay. So then we would have covered some of the questions to arrive at how does the FRA works. Now this is a FRA of 3 by 6. That means after 3 months, for 3 months, the borrowing or lending will happen. That is up to the sixth month. Okay. Now, sometimes the question will ask you to calculate the value of that FRA. How do you really arrive at the value of the FRA? Let's say in this example, we have taken 3 by 6, right? So as per the chart, if you see, we are here third month and then we are here sixth month. Okay. So 0 to 3 and 3 to 6. Now what will happen here? 0 to 3. Now students, you would know that in the market, different interest rates are quoted for the different maturities. Let's say 6 month rate is quoted, 3 months maturity rate is also quoted, 1 month, 1 year, right? For different maturities, there are different rates that are quoted. For example, 6 months, 5% per annum is quoted. If you deal in any maturity, sorry, if you deal in any maturity of 6 months, then 5% per annum will be applicable. Sorry. If you deal in a security of 3 months maturity, then the interest rate of 4% per annum will be applicable, right? And so on and so forth for 1 month and 1 year also they would have given. Okay. Now, what is happening here, students? We will have to find out that what is the interest rate applicable after 3 months up to sixth month, right? That is what we are trying to identify. So there is a way to do that. One, we will have to see that what is the 6 months rate of interest, and we will have to multiply with 6 by 12, which is 6 months rate of interest is 5%. So that means the 1 rupee on today will become this much of value after sixth month. Correct? Similarly, 1 rupee as on today will become 1 plus 4% into 3 by 12 after 3 months. In this, if we also multiply, if we assume it to be the X percent for the interest rate from third month to sixth month, so X percent into 3 by 12, if we solve for this equation, we will get that what is the theoretical minimum value of X, that is the forward rate agreement for 3 by 6. Because 6 months rate is this much, 3 months rate is this much, balance 3 months rate is this much, which is 5.94. Now, students, if FRA is available at lower than 5.94, then what will you do? Then FRA is underpriced. If anything is underpriced, what you do? You purchase. Purchasing means what? You borrow through FRA. So you borrow through FRA. Then what will happen? Borrow for 3 months, FRA 3 by 6, and invest for 6 months. So what is happening here? Since you are borrowing here, you will again borrow here for 3 months, and whatever amount you have borrowed, you invest for 6 months. Then you see you will get gain. Okay. So how? So let's say you first borrowed for 3 months at 1 lakh rupees. On maturity, let's say it turns out to be 1 lakh 3,000 rupees after 3 months. Then you have entered as 3 by 6 FRA against the borrowing position. So you will again borrow. I mean, through that, let's say it comes out to 1 lakh 6,000. So total you will get 1 lakh 6,000. But this 1 lakh you would have invested for 6 months, you will at the end get 1 lakh 7,000. These are all just hypothetical numbers to explain you. So net 1,000 you are getting an arbitrage gain. This is what we are trying to explain. So using this theoretical minimum value, you can see whether your FRA is underpriced or overpriced. If it is underpriced, then you need to borrow. If it is overpriced, then you need to invest. And the opposite position you need to take for the entire period of 6 months. If let's say you are borrowing here, then invest here for 6 months. Clear? If you are investing here, then borrow for 6 months. Clear? I hope the strategy is clear, students. And when to borrow and when to invest will be governed by the theoretical minimum value of that FRA. Now let's take case 2, where FRA is available at higher than 5.94. That means it is overpriced. If it is overpriced, then what you do? You will short sell your FRA, correct? That means into the lending position. So you will be investing through FRA. Okay, that means you will invest here, and then borrow here. Now, how will it make sense? Borrow for 6 months, invest for 3 months, then again using the FRA, again invest for 3 months. If you will compare your after 6 months cash flow from borrowing and investing perspective, you will be at a gain, students. Okay. Now there are two ways to settle this. One is gross basis, one second is net basis. Actual borrowing or lending at the rates which are specified in FRA. So this will happen. So like in a forward, in a derivatives forward we discussed, right? There are two ways how you can settle it. One is by actual physical delivery of that asset, and second is by only paying the differential as a net amount. So here also the net amount, pay or receive net, can happen, or the gross basis where you can actually borrow the entire amount or actually lend the entire amount. Interest rate futures is actually inversely proportional to the bond prices that we know, right? So, okay, sorry, wait. So, till here, we have discussed about all the concepts in the forward rate agreements. If there is any question, let me pause for a second and see. There is nothing as of now. Okay, perfect. Okay, yeah. So, forward rate agreement is very much similar to the forwards that we have discussed in the derivative section. Okay, now let's come to interest rate futures. Interest rate futures are based on the concept of bond prices. And we all know that bond prices are inversely relationship to the interest rate changes. If the interest rate goes up, the bond prices goes down. If the interest rate goes down, the bond prices goes up because both of them are inversely related. If the interest rate goes up, then you should do the short selling of bonds futures. If you want to gain while the interest rate goes up, then you should short sell the bonds future so that the interest rate goes up, bonds futures will go down, and you will gain. If you expect that the interest rate will go down, that means you will have to take a long position in bonds futures so that if interest rate goes down, the bond prices goes up, you will end up gaining the amounts. So, just to tell you that in real market scenario, the interest rate futures are not traded, but they are actually represented in the form of bond futures, and those bond futures are used to trade or are used in the interest rate risk management, students. I hope this is clear. Perfect. Now let's come to the interest rate options, which is the interest rate guarantee. Now, this is very similar to the options that we have discussed in the derivatives section. So, what are the two different types of interest rate options? One is the cap option. So, the cap option is a contract right or privilege to borrow. Here, the position is what? To borrow a specified amount, which is a notional amount, at a specified interest rate. Even this interest rate is also specified here on a specified date. Clear? So these are the terms of the options. The interest rate option wherein you are having an option to borrow at a specified rate of a specified amount on a specified date. Now these are the very much particulars of this. Now how is it different from a forward rate agreement? Because forward rate agreement is also giving you the contract to borrow, but there if even the prices comes down, or let's say the interest rate comes down, then also you will have to honor that commitment. But here you are not going to honor the commitment until it is favorable to you. If it is not favorable to you, you will not enter into the execution of the contract. If it is favorable to you, you will enter into the execution of contract. Again, I'm saying this is very much similar to the options part, because in options also you will again execute it if you feel if it is relevant, or if you feel if it is going to add a value, and that will only happen if the situations are favorable to you from the borrowing standpoint, students. Okay. Now the buyer, holder or borrower, and here is the seller or investor. Right? There are two parties to it. There will be a buyer who will be similar to a borrower position, and the seller of this cap option will become the investor. The second one is the floor option, students. Now, floor option is also a contract or a right or a privilege to invest. Okay, here the change is to invest a specified amount, which is a notional amount, at a specified interest rate on a specified date. Okay. And there is a holder or buyer, and there is a seller or borrower. So the holder or buyer will become the person who would want to invest in this case of a floor option, and the seller of the floor will become the borrower later on. Okay. Clear? So if you see, now here also there is an option. It's not a mandate to invest at this rate. You have an option that up to 3 months, or let's say up to 1 year, you, if you want, you can invest into this, right? And that is where the notional amount will be there. Now, around the premium. Now, if you see, the counterparty is giving you a commitment that the counterparty will honor in case you want them to honor. Okay. So that premium will also be paid in the form of a cap or a floor, right? Whether it is a cap option or a floor option, the premium will be paid. So premium will be paid by the buyer and it will be received by the seller, first of all. The buyer will be the buyer of the option, the seller will be the seller of the option. The cap, in the case of a cap option, it becomes a borrower. In case of a floor option, it becomes a investor, right? We are talking about the buyer's perspective here. And the seller's perspective, from a cap option seller perspective, that person will become the investor and the seller of floor option will become the borrower, right? So that position is clear. Now for the payoffs for buyer and seller of cap and floor. Now the cap option, students, is giving a right to borrow, correct? So from a holder or a buyer perspective, and in the floor option, it is right to invest. In both the cases, let's assume that the strike rate is 10% students. The premium is going to be 1% in both the cases. Let's say the actual interest rate comes out to be 12 and 12. So what will happen for the cap option for the holder? If the interest rate is higher, there will be a 2% gain. 12% minus 10%. And here it will be no gain, no loss situation. Why? Because the right to invest will not get exercised here. Actual investment will happen at 12%. The contract will not be exercised of the option. The right to invest at the rate of 10% will not be exercised here. Clear? The actual interest rate, let's say, comes to 8 and 8%. In such a situation, what will happen? If it comes out to be 8 and 8%, then from a right to borrow perspective, which is at the rate of 10%, do you feel the person will borrow at 10% if in the open market that person can get at 8%? The answer is no. So there is no gain, no loss here. Similarly, right to invest in case of a floor option at 10%, the actual market rate is only 8%. So here the right will get executed at 10% and 2% gain will be there for the option holder. Clear? So the payoff is clear here, students. And the equal and opposite payoff will be for the option writer. In this case, 2% loss will be there. In this case, nothing, no gain, no loss will be there. And if the actual rate of interest is 8% for a call option, for a cap option seller, nothing will happen. For a floor option seller, 2% loss will be there because 2% payoff will be happening from the floor option seller to the floor option buyer. Okay. So let me come to interest rate swaps. So students, till now we have discussed about asset and liability method. Then second one was forward rate agreements. Third one was interest rate futures. Fourth one was interest rate options, which is the interest rate guarantee. Now let's come to the interest rate swaps. And as I said that all these 3 4 methods that we have discussed are very much similar to the forwards, futures and options concept in the derivatives. Now this is a new topic on swaps. So interest rate swap means that we are swapping the interest rate obligations on, let's say, certain terms and conditions. Now let's take an example. Here company A is a well established company and its preference is to borrow in floating. Company B is a new company, they prefer to borrow in fixed. Let's say they have just started, they want to borrow in fixed. Company A goes to its bank A and asks for the loan quotation. Bank A says that if you want to borrow in fixed, I will give you 7%. If you want to borrow in floating, I will give you MIBOR equivalent amounts. MIBOR means the benchmark rate, Mumbai Interbank Offered Rate, right? It's a rate at which the dealings happens in the market of the banks. Now, Bank B gives to company B the quotation of if you want to go for fixed 10%, floating MIBOR plus 1%. Right now, company A and company B already know their preferences. One option is that they can just go and borrow. So let's say company A can borrow in floating and company B can borrow in fixed and they can just close the deal. But in case they feel that if there is an overall reduction possible, so what they will do, they will approach a swap bank. Okay, and the swap bank, what it will do, it will actually see both the proposals and do some calculation. Now, what is that calculation? Swap bank will say that, okay, let me figure out two different options. Option one, if company A borrows in fixed, which is at 7%, and company B borrows in floating, which is MIBOR plus 1%. So overall, it will give us MIBOR plus 8% for the overall borrowing amount. Option two comes as that A will borrow in floating and B will borrow in fixed. So in this case, the overall amount comes as MIBOR plus 10%. And this is the individual preferred borrowing case as well. So here what will happen, students? Here if you see option 1 is cheaper than option 2. Now what will banks say? Bank will say that okay, both of you execute fixed for A and floating for B. Then A will say that no, I want to have a preference of floating. Swap bank will say that okay, wait, you do that, then you swap your fixed obligation with me and you pay me MIBOR, which is the variable rate. Similarly, company B will say that okay, why would I do that? Why would I do the reverse side? So swap bank C will say that okay, company B, you take a loan in floating and then I will pay you the floating rate, you pay me the fixed rate. So the way they will do is swap bank company B will pay to swap bank fixed as 8.25. I will arrive at this number how they have arrived at. And swap bank will pay the fixed amount of 7.75 to company A. Company A will pay 7% to bank and he have taken loan. Company A will also pay MIBOR equivalent to C. Similarly, swap bank C will pay MIBOR to company B and company B will pay MIBOR plus 1% to bank B. This is how the plus minus will happen. Now, after swap, what will happen from company A's perspective? Company A is paying MIBOR to swap bank. It is paying 7% to bank and it is receiving 7.75 from swap bank. Clear? So that means overall for company A, it becomes MIBOR minus 0.7 percentage, right? And for company A, it becomes the floating rate. For company B, MIBOR is being paid, MIBOR is being received, so that gets cancelled out because whatever is being paid, whatever will be received, 1% and 8.25% in totality will bring out the 9.25% as the fixed, right? So the total collective interest payout will be MIBOR minus 0.75 plus 9.25. Okay. So that means the overall interest payout will be MIBOR plus 8.5. And bank A and bank B collectively did how much? They did collectively as MIBOR plus 8%. So that means 0.5%, the extra amount that company A and company B are paying will be kept by the swap bank as its own commission, right? Now, if you compare option 2 and option 1, which is MIBOR plus 10% minus MIBOR plus 8%, right? We have finally gone ahead with option 1. So there is a 2% gain, students. So that 2% gain, how it is distributed? Company A has kept 0.75, company B have also kept 0.75, and Swap Bank have only kept zero point 0.5. So overall, 2% gain is split in this ratio. Had they have not done any swap, company A would have been paying MIBOR, company B would have been paying 10% basis their floating and fixed preferences. This was floating preferred, this was fixed preferred, and swap bank was getting nothing. But after swap, company A's interest obligation is only MIBOR minus 0.75, and companies B's obligation becomes 9.25, and swap bank is getting zero point 0.5. So overall 2% savings is actually determined through this. So if you see in swap, this is the concept of swap. In swap, what was happening? The fixed obligations were getting swapped against the floating obligations. And swap can be for anything, students. Okay. If you want to convert fixed to floating, or floating to fixed also. Similarly, if let's say you have taken a USD loan and you want to convert into INR rate, even that is also possible. Or you have taken INR loan and you have to convert into USD rate, even that is also possible. Okay. So in both the cases, there is a swap that we have agreed and entered into. Okay. So swap means swapping your obligation. So clear, students? Now, let's quickly move to the case studies that we have in place. Yeah. So, students, we have covered case scenario 1 and case scenario 2. Now, let's start with the case scenario 3. Let the pages turn. Let me meanwhile open the case studies. Case scenario 3, students. 1 and 2 we have covered. Let's start with the third case scenario and cover all of them in sequence now. Okay. Perfect. You, as an investor, had purchased a 4-month European call option on the equity shares of X Limited. Okay, so we have purchased a 4-month European call option of rupees 10, of which the current market price is 132 per share and the exercise price is 150. Okay, you expect the price to range between rupees 120 to 190. Expected share price of X Limited and the related probability is also given. So they have given us the different expected price and the different probability. From the information given above, choose the correct answer to the following questions. The expected price of share of X Limited at the end of 4 months shall be. Now they're asking us to calculate the expected price, which is just the probability multiplied by price. Correct? So case study 3 for the first part, students. Right? We will just take the probability price, right? So 120, 140, 160, 180, and 190. 0.15, 0.10, 0.50, 0.20, and 0.05. So in totality, we will get 160.50. We just have to multiply and take a summation of this. Right? So the correct answer becomes B. Suppose if the exercise price prevails at the end of 4 months, the value of the call option shall be. Now this is very easy and simple, students. They are saying if the exercise price prevails. What is the exercise price? 150. And if the actual price is also 150, so the value of the call option will become 0. And in this case, either the option can be executed or it cannot be executed. It will fetch you the similar result because it is at the money. Right? It's not in the money, it's not out of the money, it's at the money. Okay. In case the option is held to maturity, the expected value of the call option shall be. Now they're asking key in case there are different expected price basis that you calculate the expected value of the option. In this case, let's first plot the probability, exercise price 0.05, 0.20, 0.50, 0.10, and 0.15. What were the expected price? 120, 140, then 160, 180, 190. What is the strike price? 150 in all the situations. So payoffs. Here it will be 0. Here also it will be 0. Here it will be 10, 30, and then 40. Correct, students? In first two cases, it will be 0. See, another thought can be that why don't you just take this and arrive at the net value? This is wrong. In this case, you have assumed that in 120 and 140 also there is some payout that is happening and you have assigned that probability to that as well, which should not be the case. You should always calculate the different payoffs in different situations and then multiply with the respective probability. So then we have to just multiply and take a summation here. It comes out to be 14 rupees. So D becomes the correct answer. Okay. Now the next part, in the given scenario, in the given different scenarios of expected prices of shares of X Limited at the time of maturity, the option shall be in the money in dash scenarios. In how many scenarios it will in the money? We just now have seen right? We just now have seen 1, 2, and 3. So in 3 scenarios, it will be in the money. So that means B is the correct option. Clear? Out of the money, had this question asked you out of the money, then it would have been 2 scenarios, students. Okay? Then fifth part. In the given different scenarios of expected price of shares of X Limited at the time of maturity, the option shall be add the money in how many scenarios? Now they're asking in how many scenarios it will be add the money. Now add the money can only happen if the exercise price is, sorry, the expected price is 150. So in none of the cases it is 150. So it will not happen in none of the scenarios it will happen. Okay. So in none of the scenarios it will become at the money. Clear? Any questions or any doubts till now, students? Now I'm putting here case scenario 4, first part. Okay. Now case scenario 4. Suppose you are a risk manager of at a financial institution and your company has loaned a significant amount of rupees 500 crore to a company X Limited for a period of 3 years at 6 months at MCLR plus 200 basis points. MCLR is a benchmarking rate. 200 bips means 2%. So whatever is MCLR plus 2% is what you have given a loan. You are concerned about X Limited's ability to repay the debt due to recent market volatility. To protect your institution from potential default, you decide to purchase a credit default swap. So this is a question on credit default swap. As we discussed, student, right? Credit default swap means credit means loan that you have given. Default means that there is a risk of non-payment. Swap means you're swapping it, right? For the same notional amount, which is 500 crore, at a premium quoted at 1% through the cash settlement, right? So that means if there is a default, actual cash will be received. That is 1% as the premium that will have to be paid. On the respective reset dates for the same period, actual MCLR rates comes out as follows. So there are 6 reset periods and there are different MCLR rates. From the above information given above, sorry, from the information given above, choose the correct answer to the following questions. The primary purpose of credit default swap is to increase the value of bonds. Is it something to do with bonds? The answer is no. To protect against the default risk of a debt obligation. This can be potentially yes. To provide guaranteed profit to the buyer. This is never the credit default swaps related objective. To create a new form of a loan? No. So to protect against the default risk of a debt obligation. This is what the primary objective of, of a credit default swap is. Which of the following statements is true about CDS contracts? CDS contracts cannot be used for speculation. So we have to talk about what statement is true here. CDS contracts are governed by government regulations. CDS contracts are private agreement between two parties, and CDS contracts eliminates all risk for the buyer. So first of all, this is not true because still the market risk is remaining. Only the credit risk is covered by the CDS. There is no such government regulations which define CDS. Cannot be used for, it can be used for speculation, right? It can be used. So the right answer is C. These are the private parts, private agreements between the two parties. Now, CDS contracts are governed by government regulations. Okay. So what we are trying to say that the CDS contracts are private agreements between two parties. That's the true part between these four options. Which organization publishes the guidelines and rules for conducting credit default swap transactions? So, although there is no government regulation, but still there is one association which governs this, which is the International Swap and Derivative Organization. Because see, SEC is a government one. This also doesn't do this also, and this also. So the overall functioning of this is actually governed by the International Swap and Derivatives Association, students. Okay, and this is being OTC in nature. OTC means over the counter in nature. Assuming no default occurs, the total premium your company will pay during the designated loan period shall be. Now they are saying that you have purchased the CDS, but after purchasing the CDS, there is no default that is happening. Then what will be the overall interest that will be paid? So we'll have to calculate that. So 1% on 500 crores for how many months we have purchased the CDS, or 3 years, right? So into 3. So for the entire tenure, we will end up paying 5 crore into 3 years, which is 15 crores. We will end up paying. So 15 crores is C part. Okay, clear? So 15 crore becomes the overall amount that the premium needs to be paid. Just allow me a minute. Allow me a yeah. Sorry. So this was the 15 crore amount that we will have to pay as a total premium for securing against the credit risk of 3 years. Suppose if the lender defaults somewhere in the beginning of the third year of loan after payment of interest up to 2 years. So up to 2 years, the interest has been received and the market value of a reference loan falls to 75% of its par value. That means if there is a default, students, please do understand this. If there is a default, that means the market value of the loan book will go down. The answer is yes. So it is going down by it is going down to 75%. That means it has gone down by 25%. Then ABC Bank will pay your company dash in a cash settlement. Now what will happen here? So first of all, for the first 2 years, right? For the first 2 years, the interest payment has happened appropriately. But since there is a default that is happening and it is bringing down the loan book value to 75%. So let's write it here. Original loan amount 500 crores. Reduction in market value is actually done by 25%. Now, the moment it has been done, it will lead to sorry, it will lead to the reduction or the loss in the books of the financial institution, and that is what it will be made good by the ABC bank, right, from whom we have purchased. So the overall book loss is 500 crore into 25%, right? So this was actually calculated as 1 minus 75%, the above value. So it will be how much? 125 crores. So in totality, 125 crores loss will be given by ABC Limited Bank, sorry, not bank, but the institution to the which institution of the financial institution. So see students, 125 crores has been paid, but here what has been received? Here the premium that was received in totality was around 15 crores only. So if you see, financial institution have only paid 15 crore, but against that, uh, the actual outflow was how much? 125 crore students. So C becomes the right answer. Clear? I hope this case study is also clear, students. Let's move to the next case study. This is case scenario fifth. P Limited is planning to borrow an amount of rupees 60 crores for a period of 3 months in the coming 6 month time from now. Okay, so this we are talking about FRA of 6 by 9. 3 months duration and 6 months. After 6 months from now, the borrowing will happen. Notional amount is 60 crore. The current interest rate is 9% per annum. This is the current interest rate quoted, but it is likely to go up in 6 months' time. Okay, so they are saying after 6 months, it is likely to go up. You are into a borrowing position. The company wants to hedge itself against the likely increase in the interest rates. Okay, you as CFO has been asked to suggest both traditional as well as modern methods to hedge interest rate risk. So, students, we discussed about both the traditional and modern methods, right? Traditional methods were ALM and forward rate agreement. Modern methods were interest rate futures, interest rate options, which is interest rate guarantees as well, and the interest rate swaps. Suppose the banker of P Limited has quoted the following forward rate agreement rates: 3 by 6, 6 by 9, 9 by 12. So, which one is relevant to us? 6 by 9. And this is the rate that is going to be applicable, which is 9.3%. P Limited has already issued redeemable bonds or debentures. From the information given above, choose the correct answer to answer the following questions. Which of the following rates shall be applicable for FRA to hedge against the interest rate risk if P Limited agrees to adopt this method to hedge against the interest rate risk? So this we have already answered, students. This is 9.3. Because 6 by 9 is the relevant FRA, 3 by 6 is not relevant. Why? Because you are not going to invest after 3 months for 6 months, right? Similarly, 9 by 12 is also not relevant, students. Correct? So only 6 by 9 is relevant, and that will lead to 9.3 percentage of the interest rate. Had we been investing through this FRA, we would have ended up having 9.2. But we are not investing through this FRA, we are borrowing through FRA. So if you are borrowing through FRA, bank will charge a higher rate. If you are investing through FRA, bank will give us a lower rate. Okay. So the correct answer is 9.3%. Then, if the actual interest rate after 6 months happens to be 9.6%, approximately the settlement amount will be. Now, this needs to be calculated, right? What is the notional amount? 60 crores. Case study, this is, I think, 5, part number second, students. Right? Notional amount is 60 crores multiplied by 9.6 minus 9.3, which is the FRA rate. Okay, but this is going to be for 4, how many months? 3 months, right? So 3 by 12 whole divided by 1 plus 9.6 percentage into 3 by 12. This is going to be the payout, right? And in this case, P Limited will gain, right? Because there is a benefit. Now, that will be how much? If you calculate this, the amount comes as 439, 453. So, shall be paid by the banker to P Limited because P Limited has gained. Okay, so C becomes the right answer here, students. Clear? Then, if the actual rate of interest after 6 months happens to be 8.8, it has come down, right? So, the third case, 60 crores into 8.8% minus 9.3% was the forward agreed rate, 1 plus, again we always take here, students, the actual rate. So please do remember, we have to take the actual rate to do the present value here. Okay, so the amount comes out to be 733,855. Now here P Limited is at a loss. It will have to be paid to banker because the rate has come down. The agreed rate was 9.3. The actual rate has come down. So there is a loss incurred by P Limited. Okay. So here what we will say, A part is the right answer. 733,855. This loss will be borne by P Limited. P Limited, sorry. Okay. Now, which of the following technique is not the modern technique to hedge against the interest rate risk, students? This was an easier one we discussed just some time back, whether it is interest rate futures, options, swaps, or forward rate agreements. So all these three are modern techniques, and this is a traditional. This is a traditional technique. I hope this is clear, students. Let's come to the last case scenario, students, which is the case scenario 6. Let me pause in between and just see if there are any questions. Yeah. So case scenario 6. Following information is related to actions taken in different situations of financial options, right? So there are three different situations that are given: situation one, two, three, and action is also given, whether it is exercised, or lapsed. Exercise price is 140, premium was 20, and spot price is 160. And this is exercised. The second situation is exercise price was 200, spot price was 175, premium was 15, and it was still exercised. The third situation is the exercise price was 300 and the spot price was higher, but it was not exercised, it was lapsed, and the premium we paid was 25 rupees. From the information given above, choose the correct answer to the following questions. In situation 3, now they're talking about the situation third first, okay? The investor's position and the amount of profit slash loss is how much? The investor's position and the amount of the profit or loss. Now, situation 3, okay, let's put it here. Exercise price is how much? 300. Spot price is 400. Now it is lapsed, it is not exercised. So, in which situation the spot price becomes higher and exercise price, it's not exercised, it's basically a put option, right? Because had this been a call option, the spot price is higher than the exercise price and this would have been exercised. But this is a put option, hence it will not be exercised. So one is clear that it is a put option. Now, if it is a put option, now please do see the options that have been given to us, students. One, put option minus 25, there is a loss. Second, call option positive 75, there is a gain. Short position, long position, short position of 100 gain, long position of 100 loss. So these options have been given to us. Now, one thing is clear, this is a put option. Now, there is a gain or a loss. So, first of all, there is no gain in terms of the payoff that is happening at the end. No payoff gain, but there is a premium that has been paid of how much? 25 rupees, right? So there is a 25 rupees of premium that has been paid. So there is a overall loss of 25 rupees considering this as a put option. So the right answer from this becomes option A, students. Clear? So this is how we have derived. The second part, in situation 1, the investor's position and the amount of profit or loss is. Now in situation 1, let's see. Exercise price was 140 and it was exercised, premium 20 and spot price 160. And premium was 20. Now students, if it is already exercised, that means spot price is higher than the exercise price and still it is getting exercised, it's a call option. So one thing is clear, it's a call option. If it is a call option, that means 20 rupees gain would have happened on account of this spot price minus exercise price from contract payoffs, and 20 rupees premium would have been paid. So there is net gain slash bracket loss. So it's a call option with zero gain, zero loss. So B becomes the right. See, in they have given put option and 20 rupees. So first of all, it's not a put option because the strike price is lower and the exercise price is higher. So that means it's a call option. So these two gets eliminated. Now within call option, the overall gain or loss will be computed using the amount that we have paid as well in terms of the premium. So 20 rupees is not the gain, 0 rupees is the net gain or loss, and hence B becomes the right answer. The last situation, students, situation number 2, the investor position and the amount of loss is. So let's write the situation first. 200 exercise price, exercise price is 200, and spot price 175. Premium is 15 and it is exercised. Now, if you see, the spot price is lower than exercise price, but still it is exercised. That means it is a put option. Because in case of a put option, if the spot price is lower than the exercise price, the option will become beneficial. Now, the payout would have been 200 minus 175, which is 25 rupees. That is the payout that would have been happened. And minus, so this is the gain to holder. And 15 rupees, there is a premium paid by holder to writer. So that means overall, we would have had a 10 rupees gain. If we talk about from the holder perspective, let me just quickly see case scenario 6. Okay. Now, first of all, it's not a call option. So I'm eliminating these two, right? It's a put option, but we have to calculate again the overall amount of profit or loss. So students, I mean, if you just see the overall gain, then it can become 25, which is wrong. It should be 10 because 25 gain on options minus 15 rupees of premium. So this is what we have done in all the questions overall, students. Any doubt, any other questions, students, that you have? So I think with this, we have covered all the case scenarios that were planned in the session. Let me just see in case is there some any query. Nothing. So with this, I think we come to the end of the revisionary sessions on securitization, derivatives, and interest rate risk management. Still, in case you have any query, you can reach out to us. So this was the revisionary aspect. Now I request C. Ashish sir to help us with the concluding remarks. Sir, you are there? Ashish sir? Okay, thank you, Gopika. So, I mean, we have covered the concepts of all the three topics, some of the case studies, and the important aspects how to do the revision, right? Yeah, I think this is it. I'm just flashing the number and the email ID as well. Ashish sir, okay, let's wait for another minute. So I would say in terms of the revision, please also do the practical questions that we have covered in detail in the session, right? Which we have not covered in these two sessions. I mean, in the series of the revisionary part. And please do mark some of the important pointers that you feel are important from the next revision standpoint in those specific questions. Okay, because that will help you to just take a quick revision on the important aspects in those topics itself. Okay, so if there is no other question, we can then probably end the session. Okay, thank you everyone. Please do revise well. Thank you so much. Yes, yes, Maniji, the session is over. We can close the session. Thank you. Thank you. Mm, let me see. Just give me a second, Maniji. I have just talked to him. He's joining. He's coming in a minute. So we'll wait for his concluding remarks till then.
Thank you, Divas sir, for completing this session. So with this, we have come to the end of the topic of live revisionary classes for the derivative, three topics. Basically, we can say last class we have started with the securitization, then we have started with the derivative analysis and valuation. Then in this class, we have continued derivative analysis and valuation. Then we have come closer to the interest rate risk management. So student, with
Yes.
this is another session we have come to an end. So revise whatever your doubts are there. You can send us the mail at this email ID, or you can contact us over the telephone. So thank you, Divas sir, once again for sparing your precious time
Thank
and
you, sir.
student. And thank
Thank
you,
you, sir.
student, for your patient listening and responding in the class. Thank you very much. Have a nice day.
Thank you, sir. Thank you. Thank you. Thank you, sir. Thank you.
Okay. Thank you.